Good morning and welcome. I am Mohini Naidu, investment analyst at Nedgroup Investments, and it is my pleasure today to welcome Brian Selmo, Head of Research at FPA. Brian is also the co-portfolio manager of the Nedgroup Investments Global Flexible Fund. Brian, it's great to have you here.
Thanks, Mohini. Nice to be here.
Let's kick right off. Brian, one of the topics foremost on investors' minds at the moment is around inflation and interest rates, and it's hard not for it to be because we've just been inundated with news about it in headlines almost every day. Now, there has been some debate around whether the inflation is transitory in nature or more structural. What are your views around this, and where do you see inflation going from here?
Oh, thanks, Mohini. So I guess first I would observe that inflation has been quite high, particularly in the US and Europe, where it's been running between 8.5 and 9%. And there's many developing countries where inflation has been over 10%. And Asia generally has seen inflation over 5%, with even Japan seeing a strong increase in inflation, I think up over 2.5% now. And this is a steep increase around the world compared to the circa 2 or less percent levels of inflation that most developed countries saw between 2015 and sort of the beginning of the coronavirus crisis. And I think in most places, inflation has been fairly broad-based. It's impacted housing, food, energy, and services. And there's probably a lot of contributors to this. If we go way back in time, we can remember that there were a number of novel financial policies enacted to combat the great financial crisis. And that sort of continued those policies for more than a decade, resulting in sort of the odd phenomena of zero or negative even interest rates in a number of different countries in terms of their sovereign government debt, and even for some corporates. And then more recently, we've seen novel programs enacted, particularly here in the US, fiscally and monetarily, to combat the COVID crisis that began in 2020. And so that's kind of set a background. And then along with that, we've seen some sort of normal, I think, cyclical activity, such as dramatic underinvestment in commodity markets, whether that's oil and gas or more base metals. And then in the last couple of years, we've seen, responsible investing mandates further curtail capital that would be directed typically towards some of those base metals or other commodities like oil and gas. And so I think that's all set a background for inflation. But this year probably is really about energy and commodity prices and their significant increase, which is now flowing through CPI and budgets worldwide. Now, that's a situation that's been exacerbated by the war in Ukraine. And I think that, further for, many non-dollar denominated economies, you've seen a very strong US dollar, which has also started to price through for a lot of those underlying commodities. Now, you mentioned, what are my expectations? I guess I would say that I don't have a particular expectation. We make a point of not having predictions or making point estimates because we recognize that the world is highly uncertain. And so we would not ever know what the future level of inflation would be, GDP, or stock market indexes. We think sort of the natural state of the human experience is uncertainty. And we build our portfolios to incorporate that type of uncertainty. Now, specifically about inflation, though, I would observe, and we try to observe the world as it is, I would observe that since the beginning of paper currencies, inflation has been persistent around the world. Now, reported inflation might ebb and flow, but if we think about what all of our clients are looking to do, the lifestyle they want to live, that cost of living has gone up fairly persistently in nominal terms, and I would expect that to continue in the future. And I think that all ultimately rests on the back of government's strong incentive to debase their currencies and sort of reduce their debts in nominal terms. Thanks, Bonnie.
Now, in this environment of rising inflation, we've seen an almost coordinated increase in interest rates across emerging and developed markets by central banks. How successful a strategy do you think this will be to rein in inflation? And are there perhaps any other tools that central banks could employ to combat inflation?
Yeah, I think, we've seen over the last number of years, central banks can be incredibly creative, and so they probably can do a lot in terms of changing banking regulations. They can probably also do things in some countries around currency controls. But, specifically with regard to interest rates, I think they'll be as successful as they want to be. Um, and it's the question that, again, we don't know is we don't know what the economic cost will be of increasing interest rates, and we don't know the political fallout from that, and then how central banks will manage that trade-off. And so, will they remain independent? That's a particular probably concern in the U.S., probably in other countries as well. And will they have the, sort of intestinal fortitude to follow through, if and as the economy weakens? I think just last week, the Fed sort of described a willingness to, weaken the economy, but, we'll see when that actually starts to show up in unemployment. So there's a number of unexpected type things. And, Mohini, if we think back, we've been having conversations for a number of years. And if we think back to 2019, we wouldn't have talked about, coronavirus or Ukraine in any of our conversations that year. And so it's probably true today that we have just as little insight into what will happen in the next 2 or 3 years, whether that's regarding the Fed or regarding the level of inflation.
Mhm. Now, in the volatility that we've seen in the last year and a bit, we've seen that some sectors and stocks have fallen more than others. Why do you think that is? And in an environment of higher interest rates, does the discount rate impact some sectors more than others?
Yeah, so I'll stick with the theme of I don't know why some stocks, have fallen more or less than others, but I would observe that over time things seem to collapse upon their own absurdity, and there was, a lot of incredibly high priced securities over the last couple years, and so it's possible just the total level of gross overvaluation led to an eventual decline, but why that's taken place over the last 6 months and it didn't take place 12 months ago or 18 months ago, I don't know. I think probably as a first order thought, a higher level of interest rates increases the cost of capital, and that should have a meaningful impact on longer and the value of longer dated cash flows. And so I think, so far this year, we've seen probably a couple hundred basis points increase in interest rates, and then a similar couple hundred basis points increase in the spread on, credit instruments. And so that's probably created a situation where the cost of capital was zero or maybe even negative some places, where now capital has a cost or is starting to have a cost, and that has an impact on how assets trade.
We've also begun to see weakness in many economies, and many are worried that recession is around the corner. So how have the higher interest rates and recession concerns impacted how you've positioned or how you've considered portfolio construction in the Global Flexible Fund?
Yeah, I would say that, we always expect there will be a recession at some point in our holding period. The average holding period in our fund is about 5 years for our equities. And so when we model out companies, we model out a low base and high case, and we buy companies that are, built both from a balance sheet and a competitive position to withstand and thrive in a recession. And so, we find that many times the strongest firms come out of recessions in better shape. And, like I said, if you have a 5 year holding period or multi-year outlook, you assume that there's going to be some kind of disruption along the way. You never know exactly when it will show up or what will be the causes, but it's sort of part and parcel of the individual security selection that we do.
Thank you. So, considering the global uncertainty and the vast array of scenarios that can play out with respect to inflation, interest rates, geopolitical uncertainty, are there any specific areas that you and the team are finding value that could fare well in this kind of environment, or any particular styles, for example, value versus growth?
Yeah, I would say that in times of fear or uncertainty, we like to, remind ourselves that the global economy is incredibly likely to be larger and more valuable 10 years from now. And we want to participate in that value creation. So we're always looking to buy, high quality franchise businesses that we think can grow on the back of long-term trends. And, we have an absolute value approach. And so we use that lens to make sure that the math works, starting with a reasonable yield on the equity, whether it's free cash flow or owner's earnings, and then model out conservative margins and growth rates to get to an equity like return. And if you hold that over time, you'll do well or do okay even with some level of volatility or some level of economic weakness. I think recently we've bought sort of an eclectic group of securities, ranging from busted tech companies like Uber and Netflix to some consumer-facing companies like CarMax and Herbalife. We've also started to purchase some, discounted convertible bonds where the bonds themselves are available at 20 or 30 points below par, and then there's some chance that we will participate in the upside if the stock does very well. We could earn a better than equity like return. And we've also bought businesses that are sort of still impacted by the coronavirus, call it production and travel cycle, where we've purchased some aerospace parts manufacturers that we think are operating well below earnings potential.
Okay, great. I think we have time to squeeze in one last question. So, do you have any last words on what investors can expect from the fund over the medium to long term, and perhaps any words of advice for what investors should be doing in this environment?
Yeah, I think the thing to expect from us is, more of the same. So we'll have a very flexible approach. We will try to avoid the areas of excess in the markets, and we'll buy stocks and bonds when we think they make sense from a mathematical perspective that I mentioned before. And we want to favor those companies that have strong and durable competitive positions, and will come out ahead over rolling 3 and 5 year periods.
Thanks, Brian. Thank you very much for sharing your time with us and for those valuable insights. Take care.
Thanks.
I think one thing is certain: higher inflation rates and rising interest rates have had all of us tightening our belts. For South Africans, we have felt the impact of soaring oil prices and a weakening currency, not just at the petrol pumps, but in our food baskets as well. And I think this highlights more than ever the importance of having a healthy allocation to offshore and in particular to growth assets in our investments at a level that's appropriate for your individual circumstances in order to grow your real wealth over time, to preserve your purchasing power, and to combat inflation over the longer term. So this may come with a little bit of volatility, or a lot of volatility even, over the shorter term, but over the long term, it remains a proven strategy to combating inflation. Thank you very much for joining.